Well, welcome everyone. Thank you for joining us today. This is Steps to Building a Successful Startup, ParadigmNEXT Webinar. I'm Aaron Rosen. Here I'm joined by Jonathan Pasky, our great guest. Very excited. Thank you for joining. And John, how you doing?
Not too bad. No, thanks for having me here.
Yeah, well, welcome. Very excited. And John, if you want to just tell our viewers and kind of give everyone a little insight to your background, how you started, what you've been doing here in Chicago. And,
sure. Yeah. So I started my career as an intellectual property attorney, a patent attorney. I worked at a couple of firms right out of law school. In about 2009, 2010, really started getting into the tech space here in Chicago, and it was really starting to grow. That was right around the time that Groupon was really starting to take off, and Chicago was getting on the tech startup map. I had a partner of mine that we started this concept called Mid-Ventures 25. It was Chicago's first tech startup pitch day, right? Very similar to what you see in San Francisco with TechCrunch Disrupt Today or the Launch Conference or the Launch Festival. We had 25 startups in Chicago, and we did it actually about 6 years ago today. And it was the first time that Chicago had anything like that. Today, now, when you get 25 startups in a room, it's no big deal. But back then, in 2010, it was really a big deal in Chicago. So we did that. I used that as sort of lead gen for building my law practice, but it just kind of took off. 2 years later, so 2010, 2011, we did the first Techweek here in Chicago. We raised an angel round of financing, and then my partner moved out to San Francisco, and we now run a company out there called DevNetwork, which does large developer-focused conferences, Developer Week, Mobile Week in New York. We also do API World, Data Week, conference called Integrate, and we've done a couple of others throughout the time as well. So we've got an investor conference coming up out there as well. So, and in the meantime, I still practice law here in Chicago. I do that actually the majority of my time now, helping startups with their initial corporate incorporation and financings, raising angel and venture rounds, and then also protecting their IP, their patents, trademarks, copyrights, negotiating licenses.
Wow. So you really started on the ground floor here in Chicago, like you said, around 2010. You started Tech Week. How have you seen it kind of exploding throughout the country and then bring it here in Chicago? How have you seen startups and digital in the tech space really grow?
Yeah, I can't count credit as a ground floor in Chicago. There were companies, though, that, like Grubhub, Sitter City, Basecamp, which used to be 37 Signals. Those are sort of the ground floor of Chicago. Those are the ones that were here since 2004, 2005, 2006, really in that space where, startups weren't startups yet, right? They had just gone through the bubble in the 2001, and everything was just starting to come back. And it really didn't come back until about 2010, after the recession, 2008 and 9. So that's really, I give credit to a lot of those guys that kind of stuck it out for those 5 years before I came along. And then you had companies like Tech Cocktail. Frank Gruber was sort of doing the first tech events here in Chicago in 2007, 8, 9, right in that space. Before that, there were other tech events that were going on. And, ITA and Fred Hoke and that group were really kind of carrying the banner right before that as well. So, I just kind of came along at a time when tech startups were really, really growing, and we were really trying to coalesce that, group here in Chicago, and kind of seeing it from that ground floor, right? So seeing it from 2009, 2010, 2011, there were maybe 2,000 to 3,000 people in the tech space in Chicago. And now, I think the numbers, you guys laugh, right? The numbers now, they say, at least the mayor's office quotes somewhere around like 50,000 people working in tech in Chicago. You've got a lot of the tech startups that, have grown up from Silicon Valley and San Francisco that now have offices in Chicago. You've got Twitter, you've got LinkedIn, you've got Facebook, Pinterest, you've got Uber. Chicago is Uber's third city. You've got Lyft. You've got all these, startups that have offices here in Chicago that, contribute to the overall space. And then, in 2011, after we did Tech Week at the Merchandise Mart for the first time, the next spring, in May of 2012, that's when 1871 opened. And that was really one of the big, putting, gas on the fire, if you will, of really growing the tech space in Chicago. That the coalition of people that came together to put 1871 and really make it the largest tech incubator that it has backing from the city, has backing from the state. Here in Chicago, really put Chicago on the map and allowed. The biggest problem Chicago always had was having startups leave or having companies leave, right? Techstars has an office here in Chicago now. They do Techstars Chicago. Started in 2010 as Accelerate Labs. And that was started because what they saw, the people that started that, Troy Hanikoff and Sam Yagan, and put that together, they saw that, look, Techstars was doing their Techstars incubator in Boulder, and 3 or 4 of the 10 were directly from Chicago. And they left because there was no ecosystem here to support them. In 2009, 10, and 11, I saw a lot of my friends, a lot of startups that were growing, including my own, my very own partner moving out to San Francisco, simply because the space here wasn't big enough yet. I stuck it out. I wanted to stay here. I wanted to see Chicago grow, and it really has flourished. It's become, if not the 3rd, maybe 4th or 5th largest, depending on what ranking you use, tech startup hub in the nation. And that's really something to be proud of around Chicago, and something that I think Chicago is such a diversified economy that it can continue to grow.
Right. And you were saying now that there's an ecosystem and foundation in Chicago. What are some of the other reasons you see a lot of tech startups continuing to work out of Chicago and really grow their company here?
I think maybe 2 big reasons. One, it's cheaper, right? I see a lot of Chicago startups, they understand that they can, when you're thinking about building a business, right? So, I've built a startup myself, and when you go on that side of it and you say on the business side, well, what do I really need to understand, right? The resources. What do I need to understand as far as when I'm hiring employees? If you look at hiring employees here versus in San Francisco, and with DevNetwork, most of our employees are in San Francisco. It's very expensive. It's expensive to live out there, and it's expensive to pay people out there. In Chicago, you can get around, 10 to 20% less in salaries for the same, type and, caliber of worker and employee. So, that's a really big thing. The Chicago startup scene really growing, and you've got the talent here. It's cheaper to live and work here. On the other side, the number 2 reason I think is the Chicago economy. If you're building a startup, one of the biggest tips and tricks of building a startup, when you first are starting something, especially if you're younger, you think starting a startup and selling to other startups is great. And it can be for a while, but really what you're looking for is selling to established companies. That's really where the money is. And as you see startups sort of grow up, that's how they start to grow up. They get enterprise clients. Chicago's got a huge base of enterprise clients. You've got more Fortune 500s here in Chicago than you do in San Francisco. And the ones out there are all tech companies. The ones here are all sorts of different companies. And most of the companies that are Fortune 500s, if they're not based in Chicago, they have a satellite office in Chicago. So you could talk to Microsoft and Chicago's Microsoft office, even though they're based up in Redmond, Washington, right? And if you look at a lot of the tech companies out of Silicon Valley and San Francisco, at least a third of them have offices here in Chicago as well, because they understand that Chicago is the hub in the middle of the country. And so putting your startup here, now it doesn't work for everybody, right? If you're, for example, if you're a machine learning startup, right, and you're dealing with high-level algorithms, you're probably going to be based in Palo Alto, Mountain View, Cupertino, San Francisco. But not to discourage any machine learning startups from starting in Chicago here, but if that's what you're doing, that's probably the hub of the action. But if you're going after a certain level of consumer, great example. One of our first speakers at our Mid-Ventures launch conference at late 2010. It was our first speaker from outside of Chicago. And we had the 2 founders of Hitmonk come out. And it was simply because I met Adam Goldstein, who was one of the 2 founders of Hitmonk, at a coffee shop in Chicago. And I said, what are you doing here? And he said, well, I'm meeting with United. I'm meeting with, American Airlines. I'm like, wait, can't you do that? No, it's like, they're all here. They're in Chicago. And those are the people that I'm talking to get listings on the Hitmonk site. And that was one of the big things for me, like a light bulb went off, to understand that, oh wow, even San Francisco startups have to come to Chicago to meet with brands. A lot of the times your marketing managers, your account executives, you've got, a really big presence with Leo Burnett, Digitas, and a lot of these bigger, ad agencies having a huge presence in Chicago, and they manage a lot of the advertising spend that a lot of these startups, if they're ad-based, are going after. And so that's a really big reason to, be in Chicago as well, if you're consumer focused in that sense.
Yeah, well, it's a perfect segue because kind of what you're alluding to earlier is all of these startups in Chicago it's great to start here because you have all these Fortune 500 companies. And it kind of brings us to the bulk of what our webinar will be about is what are some steps aside from connecting with these big companies to kind of get them as clients or work with them to really ensure that you can grow and build your brand.
Yeah. I think when you're launching a startup, you've got three major things that you're really focused on. And we're assuming now we're going along the lines of, a venture capital focused startup or a startup that's looking to raise capital and looking to raise money. There's lots of types of startup companies you can build. But, on one specific model is a startup that you're building in order to raise capital and then from there grow and then, either take that to an IPO or an exit. That's the sort of startup thread, the startup model that's been growing over the last 30 years, if you will, from venture capital in that industry and understanding how they fund companies, right? So that's kind of what we're talking about here. The three main things that you have are your idea, your partners that you're getting in bed with, if you will, and who you're going to get them to invest in that company. Because the model there is you've got to get some financing a lot of the times in order to prove out the model and get to cash flow positive and get the customers into the door. Your idea is your idea, right? You pick your idea. You figure out what you want with the idea, and that's your biggest choice. But at the end of the day, your idea can change. Your idea can pivot. You can deconstruct that entire idea and go in a different way altogether. A great example of that recently is Meerkat. Meerkat launched about a year ago today at South by Southwest, about the week before South by. And they were the first ones out of the gate with live video, right? Periscope launched about 3 to 4 weeks later. Periscope had just been bought by Twitter, but Periscope wasn't out yet, right? Periscope became the number live app that's out there on the internet right now and on your mobile phones. They are the clear winner. Last week, Meerkat said, we're pivoting, we're getting out of live video. They raised like $14 million, but they literally are changing their entire business model because it didn't work for them. Now they've got some runway left. What are they going to do? That's tough, right? But it's just sort of proof that your idea can change. The next two things are sort of the team and your investors. And those are really, really important things. Figuring out who to put together, right, in the team that you're going forward with. As a startup attorney, I see a lot of the times this piece isn't thought out. Sometimes it is, sometimes it isn't. But a lot of the times when it isn't, it becomes sort of a death knell for the startup. And you don't see it as, working in the startup until it's too late. And a lot of the times, if somebody from the outside is telling you about it, you also don't see it. You ignore it because you don't think that it can be real. But I see a lot of startups. They fail mainly because of team, because of, at the end of the day, it's just people. It's you, me, it's anybody that's getting together, and if we're not aligned with 3 or 4 main things, right? How much money do we make? Where do we want to be in 3 to 5 years? What sort of egos do we have, and can we make our, those egos work together, with the team? And then what sort of skill sets do we have? And are those duplicative or complementary? And if I start a startup with 2 developers, but I've got nobody in sales, then you're not going to make it. But you might. There's a niche that you might make it in Silicon Valley. Because if you've got that, maybe you find somebody, an investor, that can help you do sales. But a lot of the times, without that piece and without that sales, acumen, you're not going to make it. And so team is a very, very important thing to figure out from the beginning. Too many startups I see worry too much about the team and too much about the equity and divvying up percentages and things like that. That's a very important thing to do. But at the end of the day, right, it's the old adage, 100% of nothing is nothing. So if you own everything of nothing and you're not building something, you're not going to get very far. So if you're playing around with certain percentages and trying to figure that piece of the equity out, but you're not out there selling, then that's the big piece in the startup. You've got the idea, but one of the biggest pieces that I can't under or overestimate one way or another is sales. So many startups forget about sales and that's one of the sort of the key factors of Chicago-based startups. And you'll hear this in the Valley, and you'll hear this by a lot of Chicago startups as well. And they'll say, we're really about making money on whatever it is we build.
Right.
Because those are the things that, as you're going along, if nobody's out there as a customer for whatever it is you're building, you're probably building the wrong thing. Start over, build something else, right? At that point, if you've got something great, it's either a moonshot type of a startup like Elon Musk and SpaceX and Tesla, and you're going to get people to put into that because you're a visionary, give you money, or you've got something that you've got to change course on to get customers that are actually going to pay for something that they actually need.
Right. So a startup has the right team, kind of what you were saying, and the idea is right there, and it's really strong. What are the next steps of getting investors and really making sure you can grow and scale?
Yeah. I see a lot of startups, and they think, okay, we've got the right team, we've got everything set up, we've got a product, now what, right? At that point, you've got two ways to make money and two ways to survive. You either take your product to market and you sell, or you go get investors and you continue to build that product, continue to build a customer acquisition strategy, sales channel until you're ready with that product on the market. Either way works, but you got to do one or the other, right? You're always, as a startup, and you should be, depending on if you're getting putting your own money into it, bootstrapping it, or getting a friends and family round, taking on some debt from your mom, your dad, your aunt, your uncle, your grandma, your grandpa, whatever it may be. And that happens more than you think, right? That actually, a lot of startups start with what I see is, self-funded. They've got somebody who's been working, saving some cash, and they put a bit of that cash in that company. Let's call it $20,000, $40,000. And sometimes there's two founders that do the same thing. Then you've got a little bit more capital, right? So now you've got $40,000, maybe to $100,000 of capital, self-financed startup. And that can last you a little bit if you're just very, very lean. The next stage is, maybe we go out and we raise a little bit of debt from, our friends and family. And now you're looking at the same sort of range, but at the higher end of that range. Maybe you're looking at about $50,000 to $150,000. And, that can also last you, some time. But when I say sometime, you're talking about, 3, 6, 9 months. And then it really starts to, because I've been there, I've done that. It really starts to get tight. And you've got to understand that at some point, you have to create that timeline for yourself. Starting a startup it's just like, being a manager in a business. You've got to understand what your goals are. Because if every day you go and you start, but you're kind of wandering aimlessly, and you're not reaching any particular goal or setting a set of KPIs or key performance indicators that are saying, okay, this is what I'm doing and getting done today, tomorrow, this week, this month, and then you're not, hitting those goals, you don't know what you're measuring yourself against, right? Starting a startup is the biggest thing I can tell you is more like playing a game with yourself. And if you aren't playing that game with yourself, you're really not playing a game with anybody. If you're playing the game with yourself, though, you're setting yourself goals and then you're trying to reach those goals. You make analogies to sports, you can make analogies to, learning to play an instrument, you can make analogies to learning to play any sort of game, but it's the same thing with a startup. It's just that with a startup, there are no rules. You make the rules up as you go. And that's the hardest part of running a startup. It's that nobody's telling you what the rules are. You have to make those rules up and then decide that those rules are real and then go meet the goals that you made up for yourself and or with your team. That to me is it's that discipline that's required that a lot of people at the beginning don't realize, that it's needed along the way. So,
yeah, and you have a lot of experience with the entire process of starting a company to starting conferences which educate entrepreneurs, being a lawyer, working with startups directly.
Yeah.
What are some of the anecdotes or stories that you can share with our viewers, and maybe some advice or tips that you've learned being immersed in this community that they can overcome, or trends really going forward further?
I'll try to leave a lot of my client ones out of there. You know, kind of the attorney-client privilege. But no, I mean, I think there's some lessons to be seen with some startups that, you know, can grow too fast as well. You know, it's a good problem to have for a lot of people, but you know, this kind of goes to that third prong of what you have when you're putting your startup together, is those investors. What you're really looking for, you've got to have a good product and you've got to have a good team. But if you have those, and there's lots and lots of startups that have those, then you're going and looking for the right investors. Because again, even if you have a good product and a good team, now that third piece with the investors could also kill you, because your investors have to be aligned with you as well. They can't be, you know, constantly worrying about operations. You have to be the one operating. They also have to be ones that are aligned with the growth strategy that you've put down, as far as, you know, what you're doing. You know, how are we going to grow year over year, month over month? They have to be aligned with that. And then they also, and this is a newer trend with a lot of the venture capitalists and angel groups out there, is really creating sort of a mentor network. And it really started, you know, with venture capitalists out of Silicon Valley, like Increase and Horowitz, First Round Capital. They're out in New York and Philadelphia, also in the Valley, that really started doing something different in the last 5-6 years, creating this network of in-house back office support that startups that are smaller can have access to within the VC firm itself. And for some it's great, for others it's not, but it really helps, you know, if you're, you know, 2 people in a room working on a startup with just your computers and you have no sales support, getting investment from a group like that will also connect you within that network to potential customers, can mean making the difference between surviving and not. You know, those are some of the things that when you're looking at your group of investors, and this is the thing too, if you've got the product and you've got the team and you can show traction, right? And traction usually is in the form of 2 things with a startup: it's either user growth or cash in the door with customers. If you can show that, you know, month over month, year over year growth, wherever stage you're at in the startup, then you're ready to go make that pitch. But when you're ready to go make that pitch, again, I've seen a lot of startups stop, right? They'll go and pitch to 5 investors and they're like, well, it didn't work, right? The average in the Valley, now this is in the Valley, so the average out there is 50 to 75 meetings that you're taking. Now, granted, in Silicon Valley and in San Francisco, you've got Sand Hill Road, and you can just go, you know, one after another to all the VCs. But that doesn't mean that out here in Chicago or anywhere else that it's going to be any easier. It's actually going to probably be harder, because you don't have that critical mass of investors here in the city. And you probably have to go find other angel groups around the Midwest, and potentially even, you know, from the coasts that'll help invest. Now, there's tools out there that'll help you, right? If you're a tech startup, you should be on the angel list. You can't not be on the angel list. You know, they're, especially in the Midwest and around outside the major centers, Gust is another platform that you can use. Crunchbase, you should be on Crunchbase. You know, you're going to get found there and you're going to be known and people can check you out. It's sort of that whole, you know, psychology of if you exist in a bubble, then maybe you don't exist. So if you're out there and people can check against you and understand who you are, what you're doing, you're getting yourself out there, now you're in the stream of where these investors are looking, right? As a venture capitalist, as an angel group, they're going through due diligence constantly, right? They're investigating, they're looking at startups, they're understanding, they're looking at pitch decks. You know, if you're a startup looking for investors, yes, you need the meetings, but you also need a good pitch deck. You need a good set of financials, both, you know, prospective, pro forma financials going into the future, and what you've done in the last snapshot of, you know, the last couple of quarters and into, you know, what's happening this year. Yeah. I mean, those are the things that, you know, as you're putting this together, the startup needs to know. It's a formula in a sense.
And I'm really interested because you kind of spoke to going to these meetings and setting up meetings with venture capitalists, but now we're seeing, and even you starting FUND Conference. a lot of different events where you can go and pitch really quickly and meet those contacts. So if you want to kind of speak to FUND Conference and then just speak to the power of these events and connecting with people.
Yeah. So FUND Conference was something that I founded last year, and here in Chicago, the first time we did an event back in Chicago, we had about 750 people here in Chicago. We had 95 startups on the floor. It was really, and you can see the difference, right? It was hard for us in 2010 to get 25 startups, and here in 2015, we were able to get 95 from aggressive advice. So, I mean, that sort of shows you sort of what has happened in the last couple of years with growth around tech startups. And, what I'm really excited about now is, the ability of these online platforms to be able to connect startups and investors a little bit more. One of the interesting things that's coming up that I'm seeing, and it's actually going to be hitting in about 2 months, is the new Crowdfunding Act. So we've got what's called regulation crowdfunding, and since 2010, 2011, and then the Jobs Act passing, with reforming or expanding what you can do with startup financing. It's kind of come in 3 different ways, and the first one was the ability to do general solicitation. So, kind of putting my lawyer hat on now a little, just telling everybody that's listening about sort of what's happened in the last couple of years and why you've seen sort of a big proliferation of startup growth is general solicitation was allowed about 1.5 years ago now, and that was 506C of Regulation D of the Securities Act, and it allowed for startups to tell more than just accredited investors that now I'm raising money. And that has now allowed some of these platforms like Seed Invest and others to really put those things out there and to allow for startups to raise on these new platforms. And then last year, the new Regulation A+ came out, and it's sort of like a mini IPO, if you will. And it's starting to get tested, but really interestingly, there's this company called Helio Motors that they do this new 3-wheeled car out of Arizona, I believe, and they just raised, I think, $75 million it was through Regulation A+. It's going to cost you a little bit more, but it's a new avenue that for some of these startups that are a little bit further along to have. And the cool thing with that was startups that are a little bit further along but want to open it up to non-accredited investors. They had over 6,000 non-accredited investors invest in their startup. And so that really opened up the field for non-accredited investors to invest. And now in May, we have regulation crowdfunding coming out. And it just got passed, and May 16th, I believe, it'll be open. And it's going to allow these crowdfunding platforms to run deals, basically, and non-accredited investors to invest. And that's going to be, it's opening up a new avenue. What we're seeing is the venture capital model that's been around for 30 years has kind of not reached its end, but it's reached this new fork in the road. And we're seeing the ability for startups to raise capital outside of the public markets, because the public markets aren't what they used to be, right? Startups aren't going and taking advantage of public markets because they just frankly don't want to. They feel they can get further along right now staying private. And a lot of startups that have raised money are sitting on a lot of cash right now. And what you're going to start seeing over the next 6 months is some of these startups sort of culling their bases of employees. And, that's this conserve cash, that they expand their runway. And they're not going to necessarily go public because the public markets aren't friendly to startups right now. So where can you go to get investment? Well, this fork in the road now is what crowdfunding is going to be doing. It's going to be interesting to see, startups and how companies are going to take advantage of it. But it's, as a lawyer and seeing that on the financing side, it's really cool.
Yeah. So it seems like kind of the gist of this entire webinar is making sure startups are really secure and ready to go and make that pitch, whether it's on platforms or in front of investors, attending events as well. So kind of to wrap it up before we toss to question and answers, what are some of the keys to make sure, and I know you alluded throughout the webinar and just to review, to make sure that your startup and your team is ready to go and pitch and take advantage of all these crowdfunding sources?
Yeah. I think, now I'll put my lawyer hat on a little bit more again, but I think when I see a lot of startups that are run by first-time entrepreneurs and first-time founders, and they forget a lot of the things of the basic building blocks of building a company. Because at the end of the day, a startup is a company. When you're building a company, there's really no difference in the DNA or the building blocks of putting that company together of a startup versus, a restaurant, right? And when you're looking at a restaurant, though, putting that together, you kind of put a different hat on and you say, well, okay, I need marketing, I need, cash flow, I need to be able to hire employees, I need to be able to have a building, I need to be able to finance and get my products. When you do a startup, you're thinking, okay, well, I just need this great product, that I can code or have coded for me and some great design, and then everybody will love it. Right? Two very different things. But at the end of the day, those are just businesses, and the startup needs the same fundamentals that the restaurant does. And so, like for example, if I have a client come to me with a brick and mortar type business, it's just a different way that they think about running that business. And a startup, a lot of the times they forget about all those fundamentals, right? Where's the operating agreement if you're an LLC? Or where's the bylaws if you're a C corporation, right? And this is a thing for startups as well. If you're serious about raising money, and I'll say this probably twice just so everybody hears this. If you're serious about raising money from venture capitalists and angel investors, you must be a Delaware C corp. There's no way around it. And that is the preferred vehicle that you will get financing through. If you are not, guys like Peter Thiel, he literally says, if you're not a Delaware C corp, I will not look at your pitch deck or anything, no matter how good you are, because you just don't get it. And those are some of the fundamental things that when you're putting together your pitch and your idea, that if you leave some of these things out, where is your founder agreement? Do you have those things locked up? Because a venture capital firm or investment firm, or anybody that's going to look at what you're doing that's not a customer, that's on the investor side, or that might be a client or somebody like that you want to bring in on the operations side, is going to look at what is this company made of, right? Doing a little due diligence, and especially investors, they do their due diligence. They have due diligence checklists that they run through and make sure that you have your T's crossed and your I's dotted. And if you don't, it could kill the investment. And a lot of that comes down to, do you have those fundamentals? Do you have the legal worked out? Do you have your finances worked out? Have you had an accountant look at your books, right? Again, on the restaurant side, if you didn't have an accountant look at your books, you'd be delinquent. But on the startup side, they think, well, okay, whatever, I'll get to that later. But it's not. It's a fundamental, Figuring out the legal side, figuring out the accounting side, very fundamental things. Figuring out your agreement between the founders and the agreements then between the investors, very fundamental things to do. And then depending on the startup, figuring out what your assets are. This is one thing that I'll say about a lot of startups. They forget that they have assets beyond whatever that program is, and they realize or don't realize that brand building, intellectual property, things that are, goodwill, customer databases, things like that are protectable and should be protected, because at the end of the day, you're growing those assets and you're trying to make those assets worth something that another company or another investor later on is going to say is worth something and buy you out or give you a higher valuation. But if you don't nurture that, if you don't protect it, then nobody else is going to either, because you're the one that's going to notice that the most, and you're the one that's going to protect that the most. So you need to make sure. A lot of second and third time entrepreneurs, they get this. They understand that because they've been burned a lot of the times, either on the legal or the accounting or the intellectual property side of things. And the next time they go and do this, as an entrepreneur, then they figure it out and they get that protected. But those are some of the things at the beginning that a lot of startups forget, and they shouldn't, because it causes some pain down the road. Sometimes it's fixable, costs you a little bit more money, and sometimes it's not. Okay. So.
Very, very good insight, and thank you again so much for just offering, I feel, to all our viewers and myself. Yeah. I'm ready to go create a startup.
You're going to start one today?
Yeah, absolutely. So I guess we'll toss it and see if there are any questions.
Yeah, a couple questions from the audience. I guess the first question, on subsequent raises, how much runway should startups give themselves? How far in advance should they start the raise process again before the money runs out?
That's a good question. On subsequent raises, you always want to give yourself at least 12 to 18 months on any raise. It gives you enough time to make a shift or pivot on what you're doing as a company. And then also, if you find that your runway is running out in that 12 to 18 month span, then you have to start cutting on your burn, basically. 12 to 18 months is always what you want to give yourself. If you're a little bit before that and the market's good, that's fine. But that's sort of also what's been happening with a lot of these startups now. They're raising for 12 months, and if the market starts to take a dive, which right now a lot of venture capitalists are pulling back and sort of reevaluating what they're putting their money into, now all of a sudden a lot of startups are on that subsequent raise going out and realizing there may not be the money out there that once was. So how fast do you want to go back out and do it? Sometimes in that sort of span, you want to give yourself, typically I tell startups that I advise, raising capital is usually a 3 to 6 month process. If you do your diligence, you get out everything you need to get out, and if you take the meetings, 50 to 75 meetings, after 15 to 20 meetings, you're going to know, right? If nobody's, picking up on what you've got to shift to, what you're doing as well. But if you're taking the meetings and people are interested, they're just not necessarily putting the money in yet, continue to take the meetings. But 3 to 6 months is your general window for raising a round, and 12 to 18 months of runway. So, sometimes you take 6 months off and you start going out there and raising money again.
Another question from the audience, this one about crowdfunding. What are your thoughts on setting high goals that are not met? Could it hurt a company's chance of raising funds in the future if they failed at a campaign and weren't able to validate their product through the campaign? Yeah.
Well, I think make a distinction, too, between what I was talking about before with crowdfunding and regulation crowdfunding, which is actual SEC-regulated equity crowdfunding with people that are accredited and non-accredited putting money into companies, and then what we kind of think of as crowdfunding now, which is Kickstarter, Indiegogo, and Circle Up, these other ones that are out there as far as platforms, which is not equity at all, right? The really interesting thing with those platforms, with Kickstarter, Indiegogo, is you are just buying a product. And when you're doing that and buying a product, those are very, very risky, but it also doesn't involve equity. So if the product fails, then, no harm, no foul. Even though that you might have put up $100, you've lost your $100 and you don't get the mug that you bought, right? Whatever it may be. But, that aside, I've seen it sort of both ways. Kickstarter, Indiegogo campaigns, and that type of crowdfunding can be a really big marketing push, even if you lose, even if you don't meet your goals. Setting a very high goal sometimes can really cause that to happen. You see a lot of them that set a much lower goal and then exceed that lower goal. But a lot of the times, too, if you set the goal too low for a certain type of startup, let's say you're a hardware startup that needs to make a product in China, and you set a $20,000 goal, you're not even going to, if you hit that and, just right above it, you're not going to get enough money to make that product. You're not going to be able to deliver this. It's taking you, at least a couple $100,000 to do that, to get prototypes and things like that. So a lot of the times, setting too high of a goal and not hitting that, there are other ways to then go out and do crowdfunding on your own through, open source platforms. And a lot of the times that can work. But the biggest thing that I can tell anybody on that sort of crowdfunding is do your research. Understand what, just like you do in, if you go to a venture capitalist and you take a deck to them, and the deck doesn't include your target audience, your, the potential for making money, and what it is that, how you fit within the scope of your industry, they're going to, take the deck and throw it in the trash can because you're not understanding where you are. You need to understand your competition. You need to understand where you sit within that and where you can find that niche. The same thing in any business goes into when you're doing a crowdfunding campaign. If you, look at the data, understand, let's say you're doing a smart jacket, right, on Kickstarter. Well, then you got to look up all the other smart jackets that have come before you or clothing that's come before you. Understand what they've done on those campaigns. Understand how much they've put those campaigns, those minimums at, study the research. You may choose something that's slightly different or a combination of all of those, but then you at least have done the research and you've got at least a fighting chance of figuring out where you should go based on what gets funded and what doesn't.
We have time for 2 more questions. This question's from Rich. What kind of multiples are you typically seeing at exits? He's heard through other webinars, any range from 20 to 40 times. Seems a little bit high. He wants to know your thoughts.
Yeah, that's a little bit high. But I think startups have been growing. Tech startups have been growing. 2009 to late 2015. You've seen valuations really tick up very high, and so it's a combination of a lot of things. But late stage startups, no IPOs coming out, a lot of venture capital firms doing follow-on rounds, a lot of corporate venture capital coming in and putting lots of money on the table, whereas 5 years ago that didn't exist. So when I say corporate venture capital, I'm talking like Intel Capital, Google Ventures, other big companies that create a venture arm and put money into it. And then, the Chinese. A lot of the Chinese companies have created venture arms and started infusing capital into a lot of startups, both in China but also here in the United States. So that's really pushed valuations up very, very high. If you go to AngelList, you can really see a lot of the valuations that are on there as far as, seed round, what a normal valuation is in Chicago, on a seed round, what a normal valuation is in Silicon Valley, and then upon exit, what the normal valuations are at that point as well. You can get that data from a little bit from AngelList, a little bit from Crunchbase. You can pay for it on Mattermark, on PitchBook, on CV Insights. Those are your big databases for seeing this information. But you should always kind of take a look at it. 20 to 40x is pretty high. You're usually seeing, depending on the type of startups, a lot less than that. If you can get out 5 to 10x, that's a win. It's not a home run, but it's a win. Singles and doubles a lot of the times when you're looking at startups. So a venture capital firm looks at their portfolio, they're expecting 6 to 8 of them to, let's say it this way. They're expecting 2 to 4 of them to fail very easily, like just done. The next ones in the middle will either fail or break even, and they're expecting 1 to 2 home runs on the top. So if you're breaking even, right, that's a win. The singles and doubles on a venture capital firm in their model are wins to them. They're not the home runs. They need the home runs to survive and raise their next round. But when they keep going, they get those singles and doubles. And so a 5x to 10x multiple, singles and doubles. 20 to 40x, now you're talking about home runs. 100x, 200x, 300x, yeah, really home runs. But, it also depends on the industry too, right? When you look at an industry where it's all about the users, you do a per unit basis on the user, and sometimes that's going to be a lot less. What's the cash flow in the industry? How much margin do you have? That's all going to go into, what the multiple is on an exit. So, yeah, 20 to 40. I wish that were the norm, but
that'd be nice.
Yeah. So.
And then our final question: how open are investors to investing outside their geographic markets? Does it make sense for a Chicago startup to focus on investors in Chicago only, or is it worthwhile to go outside their market?
If you asked me the question 3 years ago, I would have said, stay with the market much more. Today, it's less important, but still important. So the idea of, on AngelList especially, syndicates, the idea that companies can raise money from people that they don't even know that are involved in somebody's syndicate that is leading around is a brand new concept that, it's been around for 3 to 4 years now, but it's really making its way and getting a lot more traction in the way that you see startups. Great example, just had a client raise some capital. Actually, a couple of clients raised capital and some seed rounds. And if I'm thinking back to those seed rounds that they just raised, we've had capital come from Chicago. We've had capital come from, California. We've had capital come from other Midwest states. So it doesn't really, we've actually had capital come from outside the country, right? So it doesn't really matter necessarily as much anymore. But I'll tell you this, a lot of the times you need, or it's preferred to have a lead that's local, or somebody that can be there to help you manage that startup as it grows. That's a big thing that a lot of other startups or a lot of other investors will look at for that startup, to understand, okay, well, great, I'll follow on, but is this guy who's leading the round going to be there? And if he or she is going to be there, or that firm's going to be there, okay, it makes it even easier. That's a step above. So.
Awesome. Wow. Just really, really great information. I know I've said it, but really learning a lot, and thank you to our viewers for those great questions. And John, thank you just so much for coming in and enlightening all of us and inspiring us young startup ventures.
So now, Aaron, you're going to go and start your startup today, right?
Seriously, and I'll give you all the credit. Well, thank you again for joining. Thanks to John, and be sure to tune into our next ParadigmNEXT webinar next month. So have a great day. Thanks.